All right, let's talk about where Wall Street stands right now, because strategists are warning that the S&P 500's rally could struggle in the near term following recent volatility. Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. Sam, it's great to have you back here on Yahoo Finance. So obviously, we're coming off a week here where the market did send some troubling signs. We are looking at some buying action here ahead of the open. Help us make sense of that recent volatility that we started to see creep into the market.
Sure. Well, good morning, Sean and Brad. Basically, I think the market has been worried about the Federal Reserve, about interest rates, and also inflation and the pressures that it is putting on consumer confidence. And also, we've been seeing, as you mentioned earlier, very good Q4 earnings, now expected to be up 16%, according to S&P Capital IQ consensus estimates versus the 8.7 initial estimate. But actually, that strength has been stealing from each of the four quarters in 2025. And instead of getting about a 12.5% growth rate expected for this calendar year, now it's down to about 9.5%. So, yeah, I think investors are a little concerned about the tariffs, what kind of an effect they will have on the economy and on inflation, and they're taking a wait and see attitude.
Sam, I wonder how you're evaluating a defensive play right now, because it seemed like, at least at the end of the last year, that defensive meant just go into technology because that was the long-term defensive play. But now you have some of those technology plays, Apple, NVIDIA, they've led some of these larger declines as well to start off 2025 here. So where are you thinking about the defensive plays that make sense right now?
Well, in last week's note, I said that investors are like fainting goats. You sneak up behind them and whisper, bear market, and their legs freeze, they fall over and are aligned into the defensive areas, consumer staples, healthcare, real estate, utilities. Also, we saw a surge in bond prices, a decline in bond yields in a flight to safety. Because the PCE number came in along expectations, I think investors did breathe a little sigh of relief. We got a relief rally as a result. But I think investors are still cautious. The greed and fear index right now is in the extreme fear area. Maybe in a short term that could represent a nice buying opportunity. But I think investors are truly concerned. And as a result, they're focusing on those groups where the demand for the products and services remains fairly static.
Sam, what happens if the tariffs are implemented tomorrow?
Well, if they are implemented tomorrow, my belief is that they will be around for a very short time. I think they are still more rhetoric than reality in terms of negotiating. I think that the president, in his State of the Union address, will continue to take a hard line and will try to call victory in some ways, whether it relates to the border, whether it relates to tariffs, fentanyl, etc. But I definitely think that if we do end up erecting those tariffs, they will be brought down fairly quickly.
What areas of the market do you expect that to reflect some of the, even if they're just interim or not long-term left on the table, but ultimately a negotiating tactic that then gets implemented, but then there's some quick resolution? Which areas of the market would feel the hit, at least on the onset?
Well, I think it's those groups that were leading to the downside as the S&P 500 was reaching the precipice of a pullback or a 5% decline, which we approached in the latter part of February. So the more cyclical areas like industrials, materials, consumer discretionary, which do have a lot of international exposure or at least are sourcing a lot of their goods from overseas. Technology also, because of the question in terms of tariffs, with China and also whatever kind of reciprocal tariffs there could end up being. So it does seem the only semi-cyclical group that it seems to be above it all is financials, and they have really been driven more so by the insurance stocks.
So when you take a look at the fact that growth trouble seems to be forming a bit, is it too early for investors to start worrying about a greater slowdown and shall I even say recession at this point?
I think it's too early to talk about recession. Granted, the stock market does tend to peak anywhere from 8 to 7 months before the start of a recession, and the market tends to bottom 5 months before the end of the recession on average. So, as the old saying goes, prices do indeed lead fundamentals. So, the market's action will indicate how serious concern is regarding the health of the overall economy.
Sam, thanks so much for taking the time here with us pre-market. Good to see you.
My pleasure. Thanks.